Good morning, everyone, and welcome to the official start of CBS Case Competition. And I actually think I will drop this one. Can you hear me in the back? How's the microphone? Someone's saying yes in the back. I don't want to run. Well, good morning on behalf of the organizing committee, on behalf of CBS. Welcome. We have a little technical difficulties, but we can do without the slides at the beginning, and hopefully we'll get the presentation later. We can go and learn. First of all, welcome to our participants from all around the world, 12 teams and the faculty advisors. Thank you to the faculty hosts that are also hosting them, and thank you to the team host as well. Second of all, thank you to all the BTLE possible participants who are here today as well, both to hear us say something about CBS Case Competition, but I believe also most likely for BCG to present on the industry. Today we have a lineup consisting of myself. My name is Mads Valsvold, and I'm half of the case writing team. And this is?
I'm this back. I am the other half.
First,
if you're in doubt.
Let's go. We're going to go over some formalities. The first formality, of course, the rules, and these are pertaining to the case participants in the official CBS Case Competition only. So for BTLE, please refer to the webpage. And any questions, please refer to the BTLE@casecompetition.com, BTE@casecompetition.com. All the case participants, please refer to either me or this. Okay, so now we're starting. Again, some other formalities before we start. When we're done, and all the case participants are starting their horrendous 32 hours of case solving, and they leave with the cases right over here, please, everyone who is not a case participant or a team host, please be seated until you're told otherwise. First, the teams will leave, then the elite participants will leave, and you will get a case handed out as you exit the door. You're also very welcome to visit the official case company booth on your way out. It's actually right now being set up in the hall as we speak. The rules for CBS Case Competition, normally I would have a slide supporting this, so they haven't changed from what's on the webpage, so don't worry, you can always refer them there. But right now we're starting the official part of CBS Case Competition, case solving, so you're no longer allowed to talk to your faculty advisor. That's why they sit in the front and you sit in the back. Business class, economy. Second of all, you're not allowed to discuss the case with your team host, meaning you can be friendly to them, you can ask them for water, cookies, but not advice on how you should solve the issue. Okay? Furthermore, another important part is, it's very important when you get the case, and when that case is in your case room, it's not allowed to leave that room for the next 32 hours. Okay? That's about the only rule you can break during those 32 hours. So keep the cases, keep your laptops in the assigned group rooms. And they look very nice, I should say. I consider this work. Second of all, until the preliminaries, when we are at hand-in deadline on Thursday, you are to hand in your solution on this USB key to your team host before 6 p.m. They will be at your group room around an hour before that time. You are, of course, well welcome to hand in before that. Second of all, should you have any questions to the case or to the rules, please give your question to your team host, who will then forward it to us. It's a very important thing about the questions. Any questions we give, we will of course try to answer, but all the teams will get the same answer at the same time, no matter which team gave that question. You will all receive an update on any question they may be given. So if you hear nothing, there's silence, that means that all teams are working hard. Okay? It will also be stated on the update which team posted the question. So on a given update, if one comes out, it will be saying case competition update number 1, which team posted the question, the actual question, and the actual answer to the case writers. That may very well be no comment, but we'll get that. We will not, of course, help you in any way. We will only discuss formalities and practicalities on the case and correct any errors that may arise. Are we there yet in this? I'm having a hard time actually doing this on the fly.
We're working on it.
We're working on it. When you hand in at 6 p.m., you are very much allowed to talk to your faculty advisor and everyone else. You are very much allowed to discuss your presentation with anyone who you may like. You're not obliged to do so, but you're allowed to do so after 6 p.m. just after the handout. When we actually get to the industry presentation by Philip in just a moment,
Well, now you got the rules. And you all understood them, right? Yeah.
So 20-minute presentation, followed by 15-minute Q&A. That's the same for both the preliminary rounds and the finals. And you're handed good. Yes, yes, yes. When we get to the preliminary rounds, you'll have access to a clicker and hopefully a computer that works. We'll see if we can get that managed in 2 days. Don't worry, we'll be working as hard as you want. Liz, will you take over?
Sure. You'll have access to a room where you can train your presentation. You'll have 90 minutes Thursday evening, 35 minutes Friday morning. The slides may not be changed after you hand in. The slides and all additional material you've included on the USB disk will be open on the computer that you have present for the presentation. Hopefully. Sure. I'm not sure if Matt said this, but you may not watch any other team's presentations. You will enter the room and exit the room again. Your faculty host may choose to either watch all of the presentations and have no contact with you, or your faculty host may choose to watch only your presentation and then have full access to you. Yes, there will be one winner of each group, and all teams in one group will present from the same panel of judges.
Hopefully when you get to the final, you'll have access to another preparation room for 35 minutes. So that'll probably be 25 minutes shaking, waiting anxiously to get into 500 participants, and 10 minutes talking to each other and saying, how good job you did for doing that rounds. As we already said, 500 spectators and hopefully streamed online. Now I'm not sure I should promise that, but we'll take a look at it. And also, very much important to remember, your performance in the preliminary rounds, no matter how good they were, does not count in the finals. So please say all the smart words once again. That was actually the rules. We have one more thing, and I think Nish will explain a little bit more about that. Because this year, we've changed the format just a little bit.
Yeah. So we've written such a good case. We believe that we couldn't fit it all into one paper. So you'll find in the case small QR codes so you can scan with your phone using an appropriate app. You do not have to have a smartphone nor a phone with internet connection, as the link is also provided under the codes. Here they are. Now, we've done the formalities. Now we get to the case itself. We start with an industry presentation, which BCG has kindly offered to make. So it's a great honor and pleasure for me to introduce, from BCG, Mr. Philip Whittaker.
A lot of skills are needed to succeed at BCG. Strategic thinking, quantitative insight, industry experience. But the most important is the ability to fill 3 minutes of silence whilst your colleague works out how the hell to work your client's projector. So well done, guys. Congratulations. Well, good morning, Copenhagen. Good morning, Singapore. Good morning, Wallabies. Let's see over there. You're looking good. I suspect you won't look as good in 32 hours' time. But what I can promise you is that you're going to be working on what to me is an incredible sector, a sector that shaped my career, and a sector that I think is an incredible playground for as many aspects of business thinking as you choose to put into it. Tell people the truth. There is a shortage. It's real. It's no one's fault. It was predictable. It was inevitable. It will get worse. Costs will go up in the future, no matter who pays for it. You can guess that probably you're not talking about semiconductors or high-tech or mobile phones. Who can guess the industry? Healthcare? Wrong. Excuse me? Automobile? Next. Energy. Got it. Welcome to energy. This man goes on, we've been using more and more per person since the Industrial Revolution began. The number of people has increased too. It's almost all come from natural resources. Energy is becoming more and more difficult to find and even more expensive to make available. This will inevitably become progressively worse. This face probably isn't that familiar to many of you. It's Bruce Henderson, who founded Boston Consulting Group in 1965. But what's perhaps more interesting is when he said those words, which certainly if you look at the news headlines of the last year or two, resonate very, very strongly today. He actually said them in 1979 in the wake of the first Iranian Revolution. At the time, extreme stress in the Middle East. And 12 months after he said those words, the oil price tripled from around $16 per barrel to about 40. What it shows is that energy has been a deeply strategic issue for a long time. And for me and my colleagues within BCG, energy is fundamental because promises that we make to our clients, those of addressing issues that are strategic, that are global, that are fundamentally value creating or create fundamental value risks, it ticks all of the boxes. It's an incredible playground. Over the next couple of days, you're going to be thinking about issues, traditional industry issues, value chains, supply chains, technology. You're also going to be thinking about ethics. You're going to be thinking about overlapping, competing, very, very complex business models. I suspect those of you who haven't had exposure to energy before will learn about the extraordinary complexity and the extraordinary stress that our energy system is under. Also about the difficult trade-offs. If there were easy answers in energy, then we would all be using a ubiquitous format. We'd all be using Mac PowerBooks, of which I must be able to see about 30 sitting from here. A dominant design hasn't emerged in energy. There's no clear leader because all of the solutions have significant downsides and significant trade-offs. And as with all the most interesting business problems, that's what you're going to be bumping up against in the day ahead. Energy, certainly for me, and our apologies for the brief introduction from both sides, but that would have given the game away a little bit. For me, has been an incredible place to pursue my career and to both internationally and in terms of the type of work we do. My name is Philip Whitaker. I'm an Associate Director in BCG's energy practice, and I'm the firm's expert on upstream oil and gas. I've been working in upstream oil and gas for almost 20 years. I started my career with Shell, where I ran offshore operations here in the North Sea, and then I ran operations deep in rainforest, in helicopter rig operations in Peru for a couple of years, and then ran a fleet of fast drilling, fast operating land rigs in the Middle East for a couple of years. For the last 10 years, I've worked as a business consultant exclusively in energy. I've worked in 25 countries, and it's given me the space to focus on issues that are large, international, everything from strategy to operations to supply chain to governance to sustainability. It's a fantastic playground, and I would encourage all of you, as you go through the case in the next 32 hours, really to push your thinking to the edges of your business studies, because what I can absolutely guarantee you is that every aspect of your study will be applicable to this sector. One of BCG's promises is chart your own course. That's a challenge to the people who we bring in, and also an offer. And certainly for me, it's been a chance to pursue something that I'm fascinated by, I love, and it's enabled me and my family with me to move around the world and do some incredible things. So I hope in this morning's session I can, A, convey some of that passion and enthusiasm, and give you, secondly, some grains of content that might help shape your thinking over the next 32 hours. So, what would I like to do in this session? Well, two things. Firstly, give you an introduction to the energy business. Sure, we're all users, we're all consumers, but what are the forces shaping our energy market? What are the trade-offs? What are the competing priorities? What are the competing technologies? What do the economics look like? What do the value chains look like? And secondly, having spent the majority of the time focusing there, now for the key question, how do I make money? What business models exist? What I can tell you is that business models are sometimes complex, often overlapping, and never easy. Our energy system is under severe stress. If you consider a manufacturing system, any of you that are engineers by profession, if you try to operate any manufacturing system at 97, 98% uptime, it simply wouldn't work. You don't design a system to work like that. Yet, our global energy system is working at something very close to those levels of uptime. So it's no surprise that with even the slightest disruption, technical, geopolitical, it becomes extremely stressed and the world suffers. May, April 2010, like yesterday, the Deepwater Horizon disaster, the biggest environmental disaster in the history of the US. For 100 days, the Macondo 242 well blew out around 50,000 barrels per day of crude in the Gulf of Mexico. No one quite knows how much. At its peak, the flow was enough to fuel the daily consumption of the US state of Delaware. Last spring, the Arab Spring, oil prices ramped up by $25 in 30 days in response to unrest in Libya. Over 1 million barrels a day of crude were removed from the markets. A system under severe, severe stress. Last year, we're just coming up to the first anniversary of Fukushima, the world's largest ever nuclear disaster, something that in many countries absolutely reshaped their attitude to nuclear, a fuel that for many was the core of filling the energy gap in the years ahead. And of course, real-time situation in Iran, as has emerged so many times in recent years. Stress in the Straits of Hormuz. The Straits of Hormuz carries 20% of the world's daily oil, a third of the world's seaborne oil every day, around 17 million barrels per day. Yet, we face a situation where that may be instantly, albeit temporarily, choked. We're working with a system here that is under extreme, extreme stress. And strategically, the planet needs to find a solution. Three forces shape our energy mix. And I would encourage you in the next 32 hours to really reflect on the issues that you're facing. Always come back to these and test your thinking against these forces, because they are always important, generally competing, and always force tricky trade-offs between compelling alternatives. Let's take them in turn. Firstly, our energy mix is shaped by the availability of those sources. Firstly, in a very, very practical sense, do they exist? Is it sunny? Do we have oil? Is there coal? But also more subtle elements of availability. Does the source provide constant, reliable supplies, or is it intermittent? And also, the supply chain. Is it stable? Is it domestic? Do I have secure supplies? Or do I rely on a supply chain? Is it open to disruption? If you ask Europe 5 years ago whether reliance on Russian gas was acceptable, they would have probably nodded their head. After Russia decided to start using gas occasionally as a geopolitical tool and interrupt supplies, suddenly that seems far less comfortable a decision. Secondly, economics. Okay, the economics of supply costs and competing costs as in any industry. But in energy, it's a little bit more subtle. There are the costs and value of subsidies to encourage new energies and to support the transition to lower carbon alternatives. I think there's also an ethical question around economics. energy is one of very few things in our lives which is, relatively speaking, non-discretionary. Any family needs to, at a minimum, keep warm and keep the lights on. And secondly, it's relatively non-transferable from supplier to supplier. So just because we don't like Apple anymore, well, we can switch to Dell. Quite the same. Even in the most liberalized energy markets, we will expose consumers to our decisions around supplies. So in a market where many families are struggling, is it really fair? Is it ethical to embed higher costs for a non-discretionary item in their bills when it's purely to fulfill our own business objectives, to fulfill carbon reduction objectives? They're tricky trade-offs. A view has emerged in Denmark that in many ways that is an acceptable price to pay. In the UK, where I'm based, there's an absolutely raging debate around whether costs for newer energy investments should be passed on to struggling consumers. And finally, sustainability. There's the green debate and the carbon debate. That's just the first level of sustainability. There are also more subtle elements of sustainability that I'd encourage you to think about in the next day or so. Elements like, what do I use land for? Where is capital best deployed? What's the real cost to society of my solution versus other solutions? So think about sustainability both in its, what we call, economist front page sense, but also push yourselves to think a little bit more subtly around sustainability. Now, no dominant source has emerged, but I think I would say that in a hydrocarbon-dominated world, many of these forces are acting, if not to undermine, and certainly to challenge and raise some serious questions about our current energy sources. Let's take a look. This is an interesting example of how these forces play out in the real world over a very, very long period of time. This is a picture of the US energy mix from the early 1800s through the Industrial Revolution to recent history. Let's talk through it. So, prior to the reason the US is an interesting example is because it's a country rich in resources, it's got plenty domestically, liberalized regulation, so regulatory effects haven't had a lot of effect on the way things have gone. Relatively rational free market economics have shaped these decisions. And it's big, so it doesn't have the issues of scale or dependence on a single source that some countries have. So, in the early 1800s, well, we fed animals and we burned wood. But then, suddenly, as the Industrial Revolution happened, firstly in Europe and later in the US, coal power became the dominant form of powering steam engines. In 1859, in Titusville, Pennsylvania, Colonel Edwin Drake, I think he was a self-proclaimed colonel, but sounds like a fascinating figure, struck oil, started the Pennsylvania oil boom, and quickly followed by gas. And gas really grew dramatically after the Second World War. Hydro has been with us for a long time, and you'll see actually it's formed a fairly stable slice of the energy mix, limited in particular by the availability of sites. Hydro is something that we would love to grow, but for many, it tends to be very site-specific. So Switzerland and Norway are tremendous hydro users, Netherlands rather less. In 1957 in the UK and 1958 in the US, nuclear came on the scene. And then, since really through the 90s at scale, we've had the emergence of other renewables, at a smaller scale in the US than in many other markets, particularly European markets. But step back, and as business students, there are a couple of interesting things about this picture. Firstly, in most markets, you tend to get technology displacement, or so displacement of one solution with the next, as the advantages and economics and convenience of one solution to an issue become challenged, another one quickly takes its place. You don't see that in this market. You get layers of new solutions adding one onto the next. Very, very unusual. What you do find is that the fuels and energy sources tend to be displaced to where they are best used. So for example, oil used to be a power generation fuel. Now 70% of oil goes to transportation because of oil's unique characteristics of being stable, transportable, and having a very, very high energy density for a given volume and weight. But in the main, new layers of supply add on. We don't suddenly displaced. Why not? Well, I think this picture tells a similar story, but starts to answer some of those questions. The world's thirst for energy is growing staggeringly. It's really being driven by two things. It's being driven by economic growth and population growth. We just arrived at 7 billion people population. By 2100, that's expected to grow to 10 billion people. Even if you stay at constant energy consumption per capita, that's a dramatic increase in overall energy needs for the planet. But also energy intensivity per capita is dramatically increasing in growth economies. Most of us in developed economies are now able to grow our GDPs without a dependence upon energy. But over the last 20 years, 2/3 of the growth in energy demand has come from Asia. And it's that growth in energy dependence and the energy intensivity of developing economies that is driving this picture. Today, in China, there are 18 cars per 1,000 inhabitants. In the US, there are 600. Imagine the gap to close if you're a lower or lower middle class Chinese. And the outcome of this is that, through the picture we saw on the previous page, every one of the energy sources is stressed and being driven to grow. You have never seen a period in recent history where a source drops off and is replaced by another. Other than, interestingly, late 90s, coal. Look, coal flattens off. What happens there is that, particularly in Europe and the US, they start to use gas as a source of power. Clean, convenient, lower carbon source of power. And coal becomes disadvantaged. Then you suddenly see that between 2002 onwards, coal grows absolutely staggeringly. What's that? That's India and China. In India, 70% of power is generated from coal. In China, it's over 80%. Coal has been the fastest growing fuel of the last decade. So, what you can see is that every one of these sources will have to grow. The challenge for each source is to find where it will be best applied, to find its niche, to find where the combination of energy content, location, sustainability issues matches the need of the consumer and the support and the demands of the regulation around it. So how does our energy mix look today? Let's drill into those graphs and lines and start talking practicalities. When talking about energy supplies of any type, it's helpful to start talking some industry language. So upstream to downstream. Upstream is all about getting access to the resources. It's about sites. It's about exploration, production. It's about finding what Mother Nature gave us and starting the process to capture it. All sources then have some sort of midstream conversion generation, essentially converting what Mother Nature gave us into a consumable product. And then finally, we have the consumer-facing elements of the business, either industrial consumers or domestic consumers, in terms of supply, pricing, and customer access. Let's dig into a few of those in detail so you can start to understand the different value chains at work. If you look at upstream oil and gas, the vast majority of the value creation commercially happens in the upstream end of the market. So if you're a company who can identify, discover, and develop oil and gas resources, you're in the money. But the challenge is around access. 90% of the world's oil and gas resources are de facto inaccessible to private companies, either in the hands of pseudo-governmental national oil companies or in the hands of Russian companies whose access conditions you might term as creative. So access is a key issue for upstream oil and gas. I mean, the Saudi National Oil Company, just to give you a feel for scale, is sitting on 260 billion barrels of oil reserves. That's 50 times the size of Shell's reserves. That starts to give you a feel for who are the big players in this market. Having created most of the value in the exploration and production segments, actually oil and gas businesses tend to be pretty tough businesses going through midstream into marketing and sales. They tend to be relatively asset heavy, they tend to be very, very competitive, can imagine retail fuel sales, for example, is a very, very competitive, challenging, low-margin business. So there, the value creation is in site access, upstream, and then running an operationally efficient and cost-efficient business through to a downstream. Coal is a mining operation. Around 7 billion tons are mined annually, about 3 billion of those in China. And once again, that's about a site access process. And then around a conversion, primarily through coal-fired power stations, into electricity. Look at how those end fuels are starting to differ, as I mentioned. 70% of oil is used for transportation fuel. Gas is used for a blend of power generation, chemical feedstock, and domestic supply. And coal is used primarily as an electricity generator. So in the case that you've got ahead of you, have a serious think. What end market am I playing with here? What am I competing against? What costs am I competing against? And what is actually a different source? Nuclear, as with so many of the, might call midstream-oriented businesses, is an asset business. These generation businesses depend upon choosing the right technology, delivering a massive piece of capital investment on time, on budget, and then operating it efficiently for a long, long time whilst managing your regulatory and pricing requirements. So these are far less about sudden value creation and geopolitical and site access issues. This is all about managing a fleet. It's all about the midstream power business, managing a fleet, making big bets for 30 years and making them right. Think about the time frame you'll be thinking of, because I suspect in energy it's going to be longer than any of the businesses that you routinely look at. And then let's swing to renewables. In renewables, upstream and extraction really means access sites or feedstocks. So either sites for offshore wind, wave, solar capacity, or access to feedstock in the form of particularly biomass capacity, either through crops or waste products. And once again, this, renewables is a question of accessing those sites, but also making bets on technology and making bets on sites and assets and site access that you will live with for a long time. And what we're dealing with in renewables, a lot more than you tend to be dealing with in the other more traditional energy segments, is technology choices. Because in very, very few areas, other than perhaps offshore and onshore wind, are there really established, relatively mature leaders and clear ways ahead in terms of technology. Most of the others, there are an enormous amount of uncertainties and rapid change in the technology landscape. Let's take a quick look at the more traditional sources. Because a question I'm often asked in my role is, are we running out of oil? Good question. What you see here is what in industry jargon is called the reserve to production ratio. It simply answers the question, well, if we continue producing at the rate we're currently producing, how many years can we produce for? What you see is that these numbers are big. Globally, we have 41 years worth of proven oil reserves. Now, this term means proven to SEC levels of rigor in the US. Actually, probably more real measure is known resources. And that's something around double that. Actually, you would think it would be economically irrational to have numbers much bigger than that, because that would mean that exploration investments have been made way, way, way ahead of when they would be needed. These are big numbers. Gas, healthier, coal, huge reserves. There are 224 years of coal reserves in the US. There are over 400 years worth of coal reserves in Russia. So in answer to the question, are we running out of traditional sources? The answer is absolutely no. What we are running out of is cheap, easy to access resources conveniently at low cost, on which so much of our modern economy has been based. We're at a point where you're seeing not a sudden break point, but an erosive emergence of serious questions around how these can go on, and an emergence of a very interesting economic tipping point, where at some point there starts to be a grey area around what the right way forward is. When the oil price in late 2008 spiked to $147 per barrel, you start to plug those economics into investments for many, many renewable technologies. They suddenly start to make an enormous amount more sense than they did when oil was $40 or $60 per barrel. So you're dealing with a market that is large, but really is an inflection point, and some important questions need to be asked around the way forward.